Look at the date on your screen. It is Thursday, January 1st, 2026. The markets just reopened after New Year's. The China export ban is now active law. And in the last 6 hours, something unprecedented has happened. I want you to look at these two numbers very carefully. Shanghai silver, 91. COMEX silver, 72. That is a 19 gap, a 26 premium. If you think this is normal market behavior, you're not paying attention. If you think this gap will close peacefully, you don't understand what's happening. And if you're looking at the 72 price on your banking app thinking silver is stable, you're staring at a ghost price while the real market is already at 91. For the last 48 hours, we have been warning you about a bifurcation, a splitting of the market. Well, today that split became a chasm. Ladies and gentlemen, as I speak to you right now, there is no longer a single price of silver. The global market has shattered into 3 distinct realities. And if you're watching the ticker on CNBC or checking your brokerage app, you're looking at the wrong reality. You're looking at a paper fiction that has nothing to do with what's actually happening in the physical world. Let me walk you through the 3-tier market that emerged this morning. Tier 1 is the panic price. This is Shanghai. The Shanghai Futures Exchange opened its first session of the year at an equivalent of 91. This is not a typo. This is not a glitch. This is the price being paid by the manufacturing capital of the world. This is the price being paid by the entities that actually consume the metal. They are desperate. They are front-running the export restrictions that just went live, and they are paying whatever it takes to secure inventory before the supply chain freezes completely. Tier 2 is the physical price. This is what you would pay if you walked into a dealer right now in Dubai, in Singapore, in Hong Kong. We are seeing confirmed transaction prices averaging 83 to 86. This is the honest physical market. It is not in total panic like China, but it is tight. It is demanding a premium. It is telling us that even outside of the export ban zone, physical silver is trading 11 to 14 higher than the paper spot price. And then we have Tier 3, the zombie price. This is the COMEX spot price in New York, currently trading at 72. Do the math with me. 91 in Shanghai, 72 in New York. That is a spread of 19. In a functioning global economy, a spread of 26 on a fungible commodity like silver is impossible. It violates the laws of physics. Arbitrage traders exist to close that gap. If they could, they would buy every single ounce in New York at 72 and sell it in Shanghai at 91. They would make risk-free billions. But they aren't doing it. The gap isn't closing. In fact, it widened overnight from 12 to 19. Why? Because the arbitrage is dead. The traders know that they cannot move the metal. They know that the January 2nd licensing requirements are now enforced. They know that if they buy silver in New York today, they cannot physically ship it, clear customs, and land it in Shanghai before Chinese authorities block it. The bridge has been burned. New York is an island of paper trading, stranded in a sea of physical shortage. So when you see 72 on your screen, understand that it is a lie. It is the price of a paper contract that nobody wants. The real world, the world of factories, solar panels, and strategic reserves, is trading at 91. That is the real price. The fact that the paper market is lagging by 19 tells you that COMEX has lost control. It is no longer the price setter. It is the price suppressor. And the physical market has finally decided to ignore it completely. But the spread is only the symptom. The disease is much worse. Because while the price is broken, the volume is exploding. We just got the delivery data from this morning's session, and it confirms our worst fears. Yesterday, we saw massive delivery requests. Today, we are seeing a run on the bank. The delivery volume hasn't just gone up, it has gone parabolic. We are talking about a 34 times increase in physical demand compared to normal January levels. Let me give you the numbers. In a typical January session, maybe 200 to 300 contracts stand for delivery. That's about 1 to 1.5 million ounces. Standard operating procedure. But this morning, preliminary delivery notices show 2,389 contracts standing for physical delivery. Let's do the math. 2,389 contracts times 5,000 ounces per contract equals 11,945,000 ounces. Nearly 12 million ounces demanded in a single session. This is not a pickup in volume. This is a raid. This is a panic event. It means that over 2,000 large entities, banks, funds, industrial giants, looked at the calendar, saw that China's export ban is now active and hit the deliver button simultaneously. They are no longer content to roll their contracts forward. They are no longer content to hold paper exposure. They want the bars. They are effectively cashing out their chips before the casino runs out of chips. Why? Because they know what the 19 premium in Shanghai means. They know that once the China export restrictions are fully enforced, the global supply chain freezes. They know that premium is going to act like a black hole, sucking up every available ounce on the planet. So they are raiding the COMEX vaults while the price is still suppressed at 72. Think about the arbitrage from their perspective. They can use their paper contracts to demand delivery at 72. If they can get that metal out of the vault, they instantly own an asset that is trading at 91 in the real world. They are buying dollar bills for 79 cents. It is the trade of a lifetime, but only if you can get the metal now, today, before someone changes the rules or the vaults run empty. This 34-fold spike in delivery demand is the system trying to correct itself violently. It is the sound of paper shorts getting trampled. Imagine being a bullion bank that sold those 2,389 contracts. You thought you were just hedging. You thought the buyer would roll the contract next month like they always do. And suddenly today, they demand the metal. You have to find 12 million ounces of physical silver today. Where are you going to get it? Shanghai is closed to you. The premiums everywhere else are 10 to 15 over spot. You are trapped. This delivery spike is the mechanism that breaks the bank. When you force a paper market to deliver physical assets at 34 times normal rate, you drain the liquidity instantly. And that explains exactly why the banking system is screaming for cash. That explains why the Federal Reserve had to intervene again overnight. If you thought the year-end injections were bad, wait until you see what happened this morning. We have uncovered another massive liquidity operation that happened quietly while everyone was celebrating the new year. The Federal Reserve executed an emergency repo operation early this morning, January 2nd. The amount was $8.3 billion. When you add that to the nearly $6 billion injected during the final days of December, we are looking at over $14 billion of emergency liquidity pumped into the banking system in just 72 hours. $14 billion. To put that into perspective, that is enough cash to buy nearly 200 million ounces of silver at current prices. And the banks burned through it in 3 days just to stay solvent. Why? Why do the banks need this much overnight cash right now? Because of that delivery spike we just discussed. You have to understand the mechanics of a short squeeze on the bullion banks. When those 2,389 contracts stood for delivery this morning, the banks on the other side of the trade, likely JP Morgan, Citibank, Bank of America, were caught in a liquidity death spiral. They are short paper, but they owe physical. To fulfill those deliveries, they have two choices. Choice 1. They deliver the metal they have in their own vaults. But their vaults are running critically low, and they are terrified of emptying them completely before we even get to February. Choice 2. They have to go into the open market and buy the metal immediately to hand it over to the client. But here's the problem. The open market is broken. If they try to buy silver in Shanghai, they have to pay 91. If they try to buy it in Dubai, they have to pay 86. But they sold the contract at 72. They are locking in a massive loss on every single ounce they deliver. They are buying high and delivering low. This destroys their cash reserves. It burns a hole in their balance sheet instantly. So they have to run to the Fed's repo window to borrow the cash to cover the spread and finance the settlement. The $8.3 billion this morning is effectively the cost of the spread. It is the price the Western banking system is paying to keep the game going for another 24 hours. And we are seeing the stress fractures appear in individual bank reports. We are hearing whispers from trading desks that JP Morgan has quietly increased its loan loss provisions for its commodities division by $620 million overnight. You don't provision $620 million for a rainy day. You provision it because you know a storm is hitting your portfolio right now. They are bracing for impact. We are also seeing reports from Citibank insiders that unprecedented physical delivery requests are clogging their settlement systems. They are delaying. They are stalling. We have heard stories of clients asking for their metal and being told it will take administrative time to process. Administrative time is banker code for we don't have the silver and we are scrambling to find it. Bank of America is reportedly extending its delivery timelines from the standard 2 days to nearly 3 weeks for large orders. Why the delay? Because they are trying to source the metal from London, from ETFs, from anywhere they can find it, because they don't have it in New York. This is a classic bank-run dynamic. But instead of people lining up at the ATM to pull out 20 bills, it is industrial giants lining up at COMEX to pull out 1,000-ounce bars. And the banks are insolvent in metal. They have the dollars because the Fed just gave them 8.3 billion of them. But dollars cannot print silver. This is the fatal flaw in their suppression scheme. They thought they could control the price forever with paper leverage. But leverage works both ways. When the lever snaps back, it crushes the person holding it. And while the banks are burning cash in New York trying to patch the holes in their delivery obligations, the situation in Shanghai has accelerated from a drain to a total depletion event. If you thought the withdrawals we saw before New Year's were dramatic, the updated numbers from Shanghai this morning are catastrophic. The speed of the drain has tripled. The Chinese aren't just taking metal, they are gutting the exchange. We have now confirmed that an additional 127 tons of silver were withdrawn during the first session of 2026 this morning. When you add that to the 84 tons removed in the final 48 hours of December, we are looking at 211 metric tons of silver removed from Shanghai in just 4 days. Let's translate that into ounces. 211 tons is roughly 6,785,000 troy ounces, gone, removed from the registered stockpile, loaded onto trucks, and driven into the dark. To put this burn rate into perspective, the Shanghai exchange typically sees withdrawals of maybe 2 or 3 tons a day during normal trading. We are currently seeing withdrawals of 50 tons per day. That is a 2,000 increase in physical offtake. This is not industrial consumption. Factories do not suddenly need 20 times more metal overnight. This is panic hoarding. This is the smart money in China looking at the active export ban and deciding to drain every last ounce before the government tightens restrictions even further. The impact on total inventory is catastrophic. Before New Year's, the Shanghai inventory stood at 727 tons. This morning, after the 127-ton withdrawal, the official count has crashed to 600 tons. Think about the trajectory. They are draining roughly 6 of the entire exchange's inventory every single day. If this rate continues, and there is no reason to believe it will stop, the Shanghai Gold Exchange will be mathematically empty in less than 2 weeks. 0. No metal left. But it won't take 2 weeks because markets don't go to zero in a straight line. They snap. When inventory drops below a certain threshold, usually around 400 tons, the panic accelerates exponentially. Buyers realize there isn't enough for everyone, so they double their orders. The run on the vault goes vertical. We are watching the beginning of that exponential curve right now. Who is taking this metal? It isn't retail. You don't withdraw 127 tons in coin form. This is the state. This is the strategic reserve. This is the battery conglomerates like CATL and BYD. These are entities with inside information. They know exactly how strict the export enforcement is going to be, and their actions are screaming at us. By withdrawing 127 tons in 1 day, they are telling us they expect the supply chain to freeze completely. They are engaging in preemptive logistical capture. They are securing the atoms before the borders lock down permanently. This creates a terrifying feedback loop for the West. Every ounce that leaves the Shanghai vault is an ounce that can never be arbitraged back to London or New York. It is an ounce permanently removed from the global float. The Western banks, the ones who are short millions of ounces, are watching this inventory drop and sweating bullets. They were counting on that metal. They were hoping China would export some silver to cool down the global price. But China is doing the exact opposite. They are locking it down, hoarding it, weaponizing it. This 211-ton vacuum in 4 days is the physical manifestation of the price split. Why is silver 91 in Shanghai? Because there are only 600 tons left and everyone wants them. Why is silver 72 in New York? Because nobody believes COMEX has the metal anyway, so the price is just a paper fiction. We are watching an inventory crisis unfold in real time. And this hoarding isn't just happening at the exchange level. It is trickling down to the corporate level. The panic has spread from state vaults to factory floors. We are seeing major industrial players, companies you know, household names, start to panic buy. They are realizing their just-in-time supply chains are about to become not in time. We have reports involving Samsung and Tesla that confirm industrial panic is no longer theory. It is boardroom reality. According to supply chain sources, Samsung has executed emergency procurement orders to secure 9 months of silver supply in advance. Think about that shift. Usually a company like Samsung holds maybe 2 weeks of inventory. Overnight, they decided to hold 36 weeks. They are effectively taking 3/4 of a year's worth of demand off the market today. Why? Because they see the same data we see. They see the 211-ton drain in Shanghai. They see the export ban active. And they know that without silver they cannot make a single circuit board. For Samsung, paying a 10 premium or even a 20 premium is irrelevant. The cost of silver is a fraction of the cost of the phone. But the cost of zero silver is bankruptcy. So they are panic buying, hoarding, and they are not alone. We have seen internal communications from Tesla's procurement division labeling their current silver inventory levels as critical. The memo reportedly authorizes purchasing managers to pay above spot to secure immediate physical delivery. This is the smoking gun. When Tesla tells its buyers to ignore the spot price and just get the metal, the spot price becomes meaningless. Tesla is bidding against Samsung. Samsung is bidding against Apple. Apple is bidding against the Chinese solar giants. And they are all fighting for the same shrinking pie. But the disconnect between paper price and real world isn't just happening in corporate boardrooms. It is happening on Main Street. It is happening at your local coin shop. If you think the price of silver is 72 because that is what the ticker says, try to buy an ounce of silver for 72. Go ahead, try. You can't. We are seeing complete decoupling of the street price from spot price. If you want to buy a US Silver Eagle right now, the current premium has exploded to over 18 above spot. That puts the real price to acquire an Eagle at roughly 90. Does that number sound familiar? It should, because 90 is nearly identical to the price silver is trading at in Shanghai. The paper price in New York says 72, but the real price in Shanghai is 91, and the real price at your dealer is 90. The market has already repriced silver. The only entity that hasn't admitted it yet is COMEX. The physical market, whether it is a factory in Shenzhen or a coin shop in Texas, has unanimously decided that silver is worth 90. The 18 premium isn't a surcharge. It is the difference between fantasy and reality. Even generic rounds, basic lumps of silver with no collector value, are trading at 12 over spot. Usually generics trade for $1 over spot. A 12 premium on generic silver is a 1,200 increase in the cost of physical acquisition. This is the market screaming at you. Dealers know they can't replace inventory at 72. They know if they sell you a coin today, they might have to pay 88 to get it back next week. So they are pricing in the future. They are pricing in the shortage. They are telling you the spot price is fake. And we are hearing that major wholesalers, the ones who supply the big online dealers, are halting sales. They are pulling inventory off websites. You will see out-of-stock buttons appearing everywhere. Or worse, you will see pre-order, estimated shipping in 8 weeks. 8 weeks is code for we don't have it, and we hope we can find it before you sue us. When you see an 8-week delay in a market this volatile, it means the mints are backed up, refiners are empty, and the system is gridlocked. So put it all together. You have Samsung buying 9 months of supply. You have Tesla scrambling for critical inventory. You have Chinese solar sector draining Shanghai vaults. And you have the retail market charging 18 premium just to let go of a single coin. This is total rejection of the paper price. The entire world, from the billionaire CEO to the small-time stacker, is voting with their wallet. And their vote says silver is worth 90, not 72. The only people still trading at 72 are the high-frequency algorithms on COMEX who don't have to take delivery. But as we saw this morning, even the paper traders are demanding delivery. Even they are trying to cross the bridge into the physical world. But the bridge is burning. This industrial panic is the final nail in the coffin for the suppression scheme. You can manipulate a chart. You can manipulate sentiment. But you cannot manipulate a factory that needs silver to operate. When Samsung needs metal, they pay the price, period. And when enough Samsungs start paying the real price, COMEX breaks. We are staring at the most dangerous 72 hours in the history of the silver market. The China export ban is now active. The supply chain is officially locked. The 19 gap is proof of systemic fracture. And the market is about to discover just how little silver is actually available. If you are watching the screen and feeling uncertain, let me be very clear. The price on your brokerage app is a lie. The real price is being set in Shanghai, in Dubai, at your local dealer. And that real price is 85 to 91 right now. Do not look at the red or green candles and feel fear. Look at them and understand what is happening. You are holding the asset that Samsung needs, that Tesla needs, that China is hoarding. You are holding the asset that cannot be printed, cannot be hacked, cannot be defaulted on. The era of paper silver is ending right now, today, this week. The era of strategic silver has begun. The 72-hour countdown is running. The gap is widening. The vaults are draining. And the repricing of a lifetime is happening in real time. Hold your position, trust your thesis, and get ready, because January 2026 is going to rewrite the history of the silver market. This is Global Market Files. The warning is delivered. I will see you on the other side of this gap.